Good evening, everyone. We'll be starting the session in 5 minutes. Just waiting for a few more clients to join in. So good evening, everyone, and welcome to this session, all-time high. I guess there's some feedback and some echo. I'll just check that in 30 seconds. So with apologies, just give me 1 second. So with Nifty reaching 19,000 and Sensex reaching 65,000, there is both excitement and nervousness among the investors. So we thought that we should come and share our views on the same. So just to explain how today's session will go, today we will have Bharat Phatak and Mandar sir speaking on the topic. Firstly, we will have Bharat sir explaining his view, followed by Mandar sir explaining his view, and then we will have a concluding session. After that, we will take a few questions from the audience. So you can use the Q&A tab over there. You can see it at the bottom of your screen. If you have any questions which you are unable to post, then you can reach out to the RMs and they can post it for you. So without further ado, I'll hand over the stage to Bharat sir and over to you.
Good evening and thanks for attending this Zoom call. This has been an interesting situation. The indices are at their all-time high. So we have the Nifty at 19,300 today, Sensex at 65,000. Even the mid and small cap indices, the BSE 500, they are all into an all-time high reading. And obviously, different thoughts will cross the minds of investors that whether I should book profits, whether I should add more, whether I should start withdrawing money from this market. And at this time, it is important to keep things in perspective. We are looking at a market which optically may look very high. But if you look at it for the last 24 months, the index has not given a very good return. We are looking at a 10-11% type of return. In the month of October 21, we went to 18,600 on Nifty, 63,000 odd on the Sensex. We came down from there in June. We were at a much lower level. Nifty was close to below 16,000. The Sensex also was close to 53,000. December last year, again, we reached the similar levels, 18,600 or 63,000. And if we look at it year to date, the indices have given only 5 to 6% return. So there has been a time correction, there has been a consolidation in the indices. And I think this is important to look at things in perspective rather than just saying that it has suddenly shot up and let me do something about it. Apart from what the markets have done, I think it is very important to look at some structural factors. And the way we have designed this session is I will be talking about some of the structural trends that we are seeing. And I will come to the valuations, how they look. Then Mandar will walk us through the situation on the global side, interest rate, inflation. And then in the concluding part, we will discuss about what the investors should do, what are the action parameters on which they can base their actions. So let me start with the structural trends. And there are 2-3 things which are clearly in favor of India. So from 5 to 4 to 3, India just crossed UK to become the fifth biggest economy in the world. And when we are looking at the next 5 to 10 years, India is likely to grow at about 6%. Germany is growing at 0.5%. Japan is growing at 0.25%. And hence, it's only a matter of time that as one of the largest economies, India can aspire to go to number 3 in the world. And I don't think it is way out in the future. Currently, our GDP stands at about $3.5 trillion. And we expect that this GDP over the next decade can go to 6.5, 7.5 trillion dollars, and India becoming the third largest country in the world. This is supported by the next factor. Next slide, please. The biggest structural change in favor of India is our working age population. Working age population is defined as people between the age group of 15 to 64. And India is the only large country in the top 10 whose working age population is growing. And this working age population is likely to grow from some of the estimates of WHO or IMF for the close to next 20-25 years. So even by 2048, India's working age population will not be shrinking. Now, look at it in the perspective that Japan's working age population started shrinking in 1990. Europe working age population started coming down in 2005. And even China peaked in 2015. So when the dependency ratio of the population is less, there are more working hands, more work is likely to be done by this people who are in this working age. We have shown that in the services sector. So the IT sector started this move in the 90s, but we have seen many other services are being outsourced to India. India has proved its credibility in the last 20 years on the services side. This, we believe, will also go on to the manufacturing side, and we'll see that in some of the coming slides. So, a working age population is our biggest strength. Obviously, the skeptics will say that we should be able to find jobs for the young people. And if we are unable to do that, there could be social issues, and which is a point well taken. But I think even on that side, India appears to be well placed. Next slide, please. So I think this is a tailwind which is developing across the world. Prior to COVID, we had become a bipolar world where US was the main consumer and China was the main producer. China had become the factory to the world. COVID underlined the vulnerability of over dependence on China, but that is only part of the story. The other part of the story is China's GDP today is more than $14 trillion. China's GDP per capita is about $10,000. India's GDP is $3.5 trillion. India's GDP per capita, per head, is $2,400. And when we compare the industrial wages in China to industrial wages in India, Chinese wages are almost 3 times that of India. There are other countries which are competing, but India manufacturing wages are lower than even countries like Cambodia, Vietnam, Philippines, Thailand. And I think this is an important part, that manufacturing is likely to shift to India, not only for a strategic reason that we don't want to be over dependent on China, but also from an economic standpoint that more competitive wages, more competitive costs are possible in India. India has a manufacturing ecosystem. If you compare ourselves to our neighbors, you will find that uh, right from the 1960s, India has invested in heavy industries. So we have companies in the public sector like Steel Authority of India, like Bharat Heavy Engineering Limited, BEML, etc., which laid the foundation of having the core industry within India. This was followed by Indian manufacturing sector, Tata, Birla, Mahindra, Bajaj, even many of the South Indian groups, creating a manufacturing culture within India. In the 1980s, with the entry of Maruti, the gap between domestic quality and industrial export quality started shrinking. And then we had Hyundai coming in. Then we had, after the liberalization, many other MNCs coming in. Indian manufacturing going through certifications like starting with ISO 9000 to 14,000 to 20,000, then going through various OE audits. And I think the manufacturing ecosystem in India is much well developed as compared to many other countries. So lower wages and manufacturing ecosystem. So there is a reason to be optimistic on manufacturing. What we have proven in services in the last 20 years, we can prove in manufacturing in the next 10, 15 years. India's share of global trade, meaning global merchandise exports, is currently 2.5%. This is where China was 20 years ago. They improved by 0.75%, 1% every year, and they reached about 16% of global exports prior to COVID. If India is able to even increase its share in global manufacturing by 0.5% a year, we will reach 7.5% of global exports in the next 10 years. And I think the stage is set for something like this to happen. And to keep things in perspective, what is 0.5% of global exports? That is about $120 billion. $120 billion is close to 4% of our GDP. So if we are able to capture that, that is the kind of business which can come into India. And in manufacturing, things are not plug and play like services. So there will have to be an investment in manufacturing facilities. This will mean that the FDI flow coming into India also will be in the similar region of $110, $120 billion a year. This has been the run rate for the last 2-3 years of FDI in India. And I think it means a more stable currency. It means a boost to our GDP. So industrial manufacturing, capital goods, the capex cycle in India is bottoming out. And I think there is a very rational reason to be optimistic about manufacturing. Next slide, please. The other part, over the last 9 to 10 years, if you see, India has been able to ramp up its infrastructure, especially the one area which is what is good for the industry. So when we live in cities and we experience traffic jams on a daily basis, we feel that we are lacking behind on infrastructure. But if you look at it from an industrial standpoint, the first picture that you see is of the a dedicated freight corridor from Ludhiana, Ambala, Saharanpur, right up to JNPT, and connecting all the ports in Gujarat. We'll be having a dedicated freight corridor. I'll just try to explain what we mean by the dedicated freight corridor. In India, we have a paradoxical situation where passenger traffic and freight traffic is on the same tracks. Passengers are given a priority but have to be subsidized. And hence, the delay in rail freight, also the costs of rail freight, make it imperative that we use truck traffic rather than rail freight. Everywhere else in the world, rail freight is much cheaper than the road freight. With the dedicated freight corridor, 3-4 big things are likely to happen. One is the travel time between Bombay and Delhi for freight will fall from 80 hours to 32 hours. So 60% efficiency will come. You can have double stacking. You can have cranes which will load and unload trains in a very fast time. Thirdly, there will be roll-on, roll-off of trucks on the railway carriages. You can have 2 kilometer long trains on this track because it is easier to schedule trains irrespective of their length. And which means that the throughput of the rail system will go up 6 to 8 times. The dedicated freight corridor, some of the parts have already been commissioned. And we are looking at possibility of the entire Western corridor starting in less than a year's time. Then we talk about roads. We are building roads will reach a network of almost 2 lakh kilometers by 2025. And this will mean a faster industrial traffic. We're talking to somebody from the textile trade, and he told us that the time required from Tirupur to Ludhiana used to be 9 days. Now it has come down to 3 days. Third part is energy, and India's pain point has been the energy costs. We import 70% of our energy requirements, and when crude oil prices go up, it pinches us. Here, India has been investing very consistently on non-conventional energy, and 30 gigawatt capacity of non-conventional is going to be on stream. India will be able to meet 50% of its energy needs through non-conventional energy by 2030. So it means two things. We are a fortunate country. We have 80% of our land area gets sunlight for 80% of the daytime, which is very, very rare in many of the European countries. So we must capture that. And we must act to reduce pollution. So we have signed up treaties where we will follow those. But I think very consistent development on solar energy, development on ethanol, and development on green hydrogen also holds the promise that our energy dependence is going to come down. So the three big things on infrastructure, which is likely to help industry. Next slide, please. What has happened with GST is India has removed the barriers of cities and states. So those boundaries have dissolved, and it is possible to address the pan-India market. This means better compliance, boost to direct taxes because of indirect taxes, and a move from informal to formal economy, which means scaling up is possible. And many Indian entrepreneurs are stepping up to take their business to scale. So one nation, one market. So I talked about FDI. Many foreign companies want to come to India for two reasons. One is the economy on the manufacturing side. The second is obviously there is a very large domestic market. I'll give you one example. Samsung manufactures about $14 billion worth of electronic goods in India. But what they manufacture in Vietnam is 4 times of that. So they manufacture $56 billion worth of electronic goods in Vietnam. But now Samsung has become 28% of Vietnam's GDP. How much more can Vietnam absorb? But when you look at India, India is a very large country. It has a very large domestic market. And when you set up a plant in India, you cater to the domestic market. Domestic market has become more accessible due to GST. So I think there is a big positive which is going in favor of India. Next slide. Digital has made a big leap in India, giant leap in digital payments. Number of digital transactions, India is bigger than US, UK, China put together. It is a frictionless movement of money. and very high rate of adoption. So India today is 4% of global GDP, but it accounts for 40% of global digital transactions. And this is not just a fancy feature, it also helps to increase the velocity of money and hence the productivity of the country. So, in manufacturing, we talk about inventory turns. If I turn the inventory 12 times instead of 8 times in a year, my profit boosts up. Here, we are turning the money around much faster, and the accessibility of this money is there to the lowest level of the entrepreneurs. So, even the chai wala finds that he can use digital payments. You must have seen your vegetable vendor, your tailor, your even the panwala is using this digital adoption, and this is adding a very big boost to the efficiency of the country, and it is increasing the velocity. More people are coming into the formal economy. They can prove their transactions. They can access formal credit due to this. So I think there is a digital revolution which we have been able to create over the last 3-4 years. And you may notice that there are other digital initiatives like the ONDC platform, which the government is going to introduce. CoWIN, you must have seen that we gave this 200 crore vaccine shots, and everybody is able to digitally see his certificate, which many of the developed countries are unable to do that. The Ayushman Bharat digital mission is going to revolutionize the healthcare services and healthcare records in India. So I think we have had this last mover advantage in the electronic or digital field. We have bank accounts, mobile phones, and digital interfaces linked up. So we have been able to give identity, and I think we cannot underplay the benefits of the digital part. Next slide. Of course, this means that our progress is not without challenges. 3 challenges I have put up for you to see over here. If global disruption for any reason means that if the crude oil prices go up, that is going to hurt us till our non-conventional energy comes up. The second picture talks about geopolitical risks. The Russia-Ukraine war, you remember when it erupted in February 22, suddenly the oil prices shot up to almost $130, $135 per barrel. And this could have put significant pressure in the Indian situation. Even 3 weeks ago, you had some kind of a mutiny in Russia, and we are keeping our fingers crossed. Thankfully, it turned out to be a storm in the teacup. But these challenges will remain. But I think some of the structural factors which are going in favor of India will prevail over this. Third part is obviously recession. The developed world is going through pressures where the inflation has shot up. They are looking at very high money supply. They are trying to increase interest rates. And interest rates in the developed world have gone up possibly 5 or 6 times from the pre-COVID levels. Whereas in the emerging world, the interest rates have been, inflation and interest rates have been sideways. So the recession in developed world can have an impact on the services, can have an impact initially, but also it will put pressure on them to reduce their costs and move their manufacturing, move their services to a lower cost economy. So if you look at Europe, got a lot of pain due to the Russia-Ukraine war. The oil prices, gas prices shot up. But at the same time, their costs are very high. European workers want to work only 33 hours in a week. for 35 euros per week, and you cannot take manufacturing back to the developed countries. So I think recession will have immediate effect. Recession can cause markets to panic, but recession will also mean that the flow of orders or flow of manufacturing to lower cost destinations will get accelerated. So no doubt the challenges are there. Next slide. Now we come to the markets. Markets are at a life high. But if we look at the valuations are not excessive. Participants have to worry when markets are euphoric or markets are in a bubble. In India, the PE ratio last 10 years average has been 20 times the earnings. Currently, we are 1 year forward, we are at 18.5 times earnings. Even price to book level, 1 year forward, we are 3 times. This is as against the 10-year average of 2.7 times. So valuations are not excessive, the markets are not euphoric, and it doesn't look like a bubble in the market yet. So it is important for investors to participate in this market. The valuation, we'll look at it from another standpoint. Next slide will show us that. Next slide, please. So this is an index of valuation. This is built on 4 parameters. First is price to earning ratio. Second is price to book value. Third is inverse yield of the government bonds. So if interest rates are high, the valuation has to come down. If interest rates are low, the valuation has to be a higher valuation can be justified. And the fourth parameter is market cap to GDP. So when you combine these 4 factors, and this is something which has worked for the last 18 years, from June 2005, there is a heat map or a traffic signal kind of a representation, where if the PE ratio, price to book value, or the market cap to GDP goes very high, the market becomes very vulnerable. And if you see June 2007 to June 2008, this index had reached 150 times. If you even look at June 18, this index had crossed 125. Currently, we are at 110. And in the traffic light kind of situation, it's a neutral situation. So it is not a cheap market for sure, but it is not a red hot or a bubble type of market. So I think on valuations, we are there. On structural situation, there are tailwinds for India. But what I have been talking about is the long-term part. Mandar will talk about how things have panned out, how things are looking currently, where we stand in the cycle. So I will now hand over to Mandar. And after that, we'll again come back to see what investors should do. So these are the questions for investors, but we'll stop sharing this presentation now. And now I think Mandar takes over.
Yeah. So thank you, Bharat sir. So actually, this slide shows the performance of equity markets across the globe. So we have selected few here, and the first 2 are the US markets, Dow Jones and Nasdaq. And as you can see in the last column, Dow Jones has gained close to 4.5% in the month of June, and Nasdaq has gained 6.5%. In the Asian markets, actually Hang Seng has gained close to 4%. Nikkei has gained 7.5%. Shanghai Composite and SK South Korean Kospi market has been flattish in this period. Among the European market, UK market has gone up 1% in the month of June. Overall, if one looks at MSCI World Index, which comprises of all developed market plus emerging market, that has gone up close to 6% in the month of June. Whereas the MSCI Emerging Market Index has gone up close to 3% in the month of June. So overall, the up move into the markets has not been confined to India. So this has been global equity up move, and India is part of overall global up move. So we are not moving in isolation. We are part of a global trend, which is money moving towards equities. In terms or in our previous discussions, we talked about risk on and risk off. So this is a typical risk on scenario which is playing at this point of time, where all the risk assets, be it equities, be it even cryptocurrencies, they are moving up at this point of time. So the environment in terms of the performance is changing. Now money is moving into risky assets as compared to 2022, where we have seen across the board there were drawdowns in global equity markets and along with other risk assets. Next slide, please. Actually, one factor which helps and which detracts Indian market is the crude oil prices. And as you can see in the chart, crude oil prices peaked somewhere in the month of June of 2022, and then they are moving down or slightly on a gliding path. So from $122, the crude oil prices have reached now $75 per barrel. And whenever the crude oil prices are benign, actually our external situation, because India imports close to 80% of its crude oil requirement, the pressure on currency, that is Indian rupee, is less whenever the crude oil prices are benign. So then the inflation is also under control because of the crude oil prices remaining under a check. So overall, crude oil price is trending downward, is very positive for India. Another important indicator which one looks at as a risk on or risk off indicator is the gold prices. So whenever there is an uncertainty in the world, the gold prices go up. So that's why it is an indicator of risk off. So in the current scenario, what we have seen is gold prices are not moving higher. In fact, they are stuck in the range. So they are trending between $1,900 per ounce to roughly $2,000 per ounce range. So in this scenario where gold prices are not going up, this shows that the environment remains benign for overall risk assets. Next slide, please. So on one side, we have seen in terms of crude oil prices, the risk for Indian economy is going down. And on the other side, we have seen GST collection improving. That means the sales of the companies is also improving at a similar rate. So if you look at the numbers are trending higher as compared to last year. And if one calculates the growth, it is coming close to 12% type of growth in the GST collection, which is happening at this point of time. So 12% growth in GST collection means roughly the companies in India are increasing their sales by 12% per year. Of course, this includes the inflation component which is there, but nonetheless, the sales are expected to grow by 12% per annum. And for the investors who are looking at average returns, which are between 11 to 13, 14% per annum. So this gives reasonable chance of making that return, because when the sales are growing at 12-13%, the profits of the corporate should also grow at a similar rate, if considering the constant margins, and that should help in achieving the investor's objective of generating somewhere close to average returns going forward. Next slide, please. So along with GST data, we have compiled data for other variables. So passenger car sales are picking up. In the month of April, we have seen close to 11.5% growth in passenger car sales. Two-wheeler sales are picking up. In the month of May, we have seen close to 17% growth in two-wheeler sales. Remember, this growth is in terms of volume and not in terms of price. So the volume growth is happening for passenger cars and two-wheeler. The cement production is increasing in double digit. Coal production is close to double digit. Steel production is close to 12.5%. There is some lag in electricity generation, but nonetheless, the other sectors are making for it. Even the infrastructure construction activity is picking up in the month of April. So coming to services, which is the second portion of this slide. So the credit to services, which is a leading indicator that so how much money banks are providing or are lending to the service sector, it has gone up by 21%. Housing loans are increasing by double digit in spite of higher interest rates at this point of time. The airport passenger traffic is growing at very faster rate. The railway freight traffic is increasing by 4%, and the e-way bill generation is also increasing at 10% per annum. So overall, the growth in economy is happening, and that is what is getting reflected into the numbers which I have shown in this slide. So as we have seen, the overall growth numbers are picking up, the risks are coming down, and we have seen on the next slide, the inflation is also coming down. So the risk of inflation leading to higher interest rate is also coming down. We have seen the wholesale price inflation, which is indicated by blue line. It has come off from close to 16% level last year to negative 3.5% currently. The consumer price inflation, which is tracked by RBI, it is close to 5% now as compared to 5.5% 1 year back. So overall inflation remain benign, and that should make sure that interest rates will not shoot up from the current level, and that should help in keeping growth momentum intact. Next slide, please. So having talked about the growth situation, the risk management situation. So we have foreign exchange reserves which are close to $600 billion now, which is more than 10 months of import cover, which is very comfortable situation from that point of view. The current account deficit, that is the difference between import of goods and export of goods. So that has reached only negligible level in last quarter. The currency is stable as shown in the bottom chart of the slide. So USD INR is stable in the region of 80 to 83 in last 1 year. So overall the risks on the external side are also lower. So so to conclude, actually the growth is picking up, the risks are coming down, the risk from interest rate rise, risk from foreign exchange fluctuation, risk from higher crude oil prices. So all these risks are coming down. So this gives a very conducive environment for equity markets to perform over next 1 to 2 years. So that's all from my side. Back to Bharat sir.
So there was a slide about the flow from foreign institutional investors, and I just will not go to that slide. What has happened is from June of 2021, the foreign investors had a risk of stance, and they were pulling money out of India, and they were pulling money out of most markets that way. And over the last 1.5 years, they had pulled out close to $32 billion of money out of India. They have turned positive only this year. So from February, March, some minor additions were made. But both in the month of May as well as June, close to $5 billion each. So this year, about $12 billion of foreign institutional money has come in. And we had a similar situation in 2007, 2008 when foreign institutions pulled out more than $30 billion. The market had crashed by more than 40% at that time. What has happened in the last 5 years is the flow from Indian domestic investors has been turning into equity. And we have SIP registrations, which now have across the country, 14,000 crores coming into SIPs on getting registered on a monthly basis. So we are looking at 1.2, $1.5 billion of equity money. The EPFO is also putting money into equity and index funds. And this domestic money has made sure that while other markets globally fell by 30-35%, Indian markets did not fall by that extent. Indian markets fell less than 15%. And now that FIs are back, what they could drive down the markets by pulling out $32 billion, only $10 billion have brought the market higher than that. We have been speaking to some of the fund managers who travel abroad and speak to institutional investors abroad. And they say that most of the institutional investors had gone underweight India. And now they see that it is one of the brighter spots in the global economy. The size is there, the currency stability is there, and the growth prospects are there. So the argument in India is whether we will grow at 6% or 7%, whereas rest of the world, developed countries are saying whether they'll have a negative growth or they will have positive growth. So many of these investors are underweight and they want to put money in India, and that is what we have seen in the last 2 months. Now, the return of FIs have benefited the Indian markets. We are at this new high, but like I said, this is not a euphoric market. This does not look like a bubble market to us. And obviously, all investors want to know what they should do in this kind of a situation. So here we come up with our suggestions. We have always insisted that investors should follow an asset allocation approach, and asset allocation approach is followed in 2 ways. One is from an investor's personal situation or family situation. So any money that he's likely to need in the next 6 months, 8 months, should be put in a very liquid instrument like bank or liquid funds. That money should be easily accessible. Any money which is likely to be required over the next 3, 4, 5 years should go into debt instruments, because when that money is needed, suppose somebody wants to pay his son's college education fees 2 years from now, his plan should not get disturbed, because when he needs the money, the market is down and he has to withdraw at a lower rate. So my 6-month money, my 3-4 year money, and money which is beyond 5 years is where the asset allocation piece comes into the picture. A thumb rule which most people find useful is at least an amount equal to your age. They say should be in debt, but everything else should be in appreciating assets like equity. If we look at asset allocation of, let's say, 50-50, if you have been following the 50-50 asset allocation, then I think we should continue to participate. If we are even weight, we should continue to remain even weight on equity. So if my asset allocation is 50% in equity, I should not draw it down to 40%. I should not draw it down to 30%, thinking that the market has gone up and let me take this money away. So I think keeping that asset allocation discipline is very important. If you are investing for some long-term goal, so there may be a retirement goal which is 12 years, 15 years away. There may be education goal which is 7-8 years away. Then I think you should ignore what the market is doing, and you should continue your discipline of putting money through the systematic investment plan, building for your long-term goals. You need not worry on the SIP whether the market is low or high, because it will average out over the next 5, 7, 10 years. And that is also an important thing, that when our GDP grows from 3.5 trillion to 7.5 trillion, the market cap is also going to grow. So stick to your long-term goal-based thing. The next part comes is my policy allocation or my asset allocation should be 50-50. But currently I'm only at 40%. Then whether should I put money in one shot, we will not advise that. We will say that continue to build up your portfolio, because you are putting 5-year money. You may have markets going up for 3-4 months. You may have markets coming down for 6-7 months after that. You average this out. Under invested, if you're still to reach your desired equity allocation, continue to invest in the same way as a long-term based, long-term goal-based investment. And I think for many of us, the fourth part becomes very important. And you say my asset allocation is 50-50. I am fully invested currently, then what I should be doing? So there are two types of investors. There are active investors and there are passive investors. The active investors will say that, okay, market has gone up for 13 weeks in a row and some kind of an intermediate downtrend can emerge. So now that market has gone up, let me take some money off the table. So I am 50-50, but I will draw it down to, let's say, 45. I'll take 10% away from equity with the hope that if the market comes down, I'll be able to add it back to equity. Best of luck with that. But I'm sure market does give this kind of a chance to investors. So if you are patient and you want to do this for a fully invested investor, that may be the right thing to do. There may be a passive investor who says that I don't want to trade in this market, or I don't want to take this short-term bets. And I think we are more aligned to that type of investor. He may say that I am following the asset allocation discipline and my asset allocation was 50-50 in the month of March. Now that the market has gone up, it has become 56-44. Market has gone up in the last 3 months by 12%. So my 50 has gone up to 56. Should I rebalance it to 50-50? I think rebalancing is the right thing to do. If the market is a little bullish, you can say that I will not rebalance in one shot. I will do it in 2 tranches. So even the passive investors should rebalance. But I think the important message that we want to bring to you is don't run away from this market. Continue to participate. Stick to your asset allocation discipline. And I think the Indian GDP in nominal terms is likely to grow by 12%, 6-7% of GDP growth, 5-7% or 5%, 5.5% of inflation. So in nominal terms, the GDP is likely to grow at 12%. The revenues are likely to grow at 12%. If revenues grow at 12%, because of the fixed costs which are absorbed earlier, earnings may go up at 14-15%. And a return of 12, 13, 14% from this market, if I am patient and if I hold on for 5 years, is not ruled out. It is something which stands the rational scrutiny, it stands the validation. And I think continue to participate in this market is the message that we want to bring to you. Thank you so much for your attention and patient listening. Some questions have started coming in the Q&A box. So there is a question from one of our respected investors, Mr. Ananta Padmanabhan, who has a very long